You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike for The Moose on the Loose. I hope you are doing well. Today I want to talk about the crazy market we've been having over the past 4 or 5 days, right? Started last week with unemployment rate in the US a lot higher than expected. Then over the weekend, an old news, but that became kind of like a new news because of media spun it like there's no tomorrow. Warren Buffett selling more than 50% of its stake in Apple and its portfolio. Kind of crazy. Is it the end? On top of that, he is building in a huge, I couldn't even find a word, like an enormous mountain of cash, 277 billion in cash. So is Buffett waiting for a crash? Is he forecasting a major crisis? So you see on one side, unemployment rate getting higher than expected. Now people are thinking about the Fed and saying, well, maybe they should have followed Bank of Canada's lead and start cutting off those rates sooner than later. Right now, maybe we're going to head into a recession because of that, and because they have been so slow to react because the economy is clearly slowing down. But it seems that we are waiting to get something worse or bad economic news to start acting on the interest rate. So those are two bad news. And then on Monday, the market woke up on a Japanese market, the Nikkei, down 13%. So panic attack over there. So let's take a look at what happened and what's going to happen forward, because on Tuesday, everything was back to almost normal. The market was up a little bit more. The Nikkei got 9% up, so it didn't fully recover, but at least send a strong signal to the market. And today, not today, but Wednesday, I'm recording this. It's 3 p.m. right now. So the attempt to have the market going back up is not a success. So I'm recording this on Wednesday at 3 p.m. I see the market right now is slightly down, not too much. We're talking about 0.20, 0.25% down. It was a little bit worse earlier, and at the morning it was actually in positive. So not a clear direction, we can put it that way. So what is going on right now? What's the panic? Well, one thing that I've been talking about for a long while now, and I've been wrong since 2022, is in 2022 I started to talk about, you know what, I think that with those the higher interest rates, and the fact that consumers have already a pretty decent amount of debt, well, if you're asking them to pay more interest, of course the economy is going to slow down. It didn't happen in 2023. I expected a recession in 23 or in 24, and still yet we're in August of 24 and I'm still wrong. But here's the thing. Now we start to realize, the market starts to realize, maybe we're actually going to get a recession, a big shocker, right? You keep on telling people, yes, spend as much as you want, everything is fine. And at the same time, you also tell them, oh, by the way, we're sorry, but you have to pay a much higher interest rate on your car loan, on your mortgage, on your line of credit. For businesses, the same thing. I've recently discussed the 3 big telcos, and one highlight was how much more they have to pay in interest. It's growing double digit aggressively quarter over quarter, because whenever they renew debt, it's not just 0.25% more. It's 1, 2, 3% more than what they used to renew their debt at the beginning. Not the beginning, but a few years ago. So the loom of a recession is growing. Now we have I see that more as an anecdote than anything else. But yeah, Berkshire Hathaway is building cash. Keep in mind, they've been building cash since 2008. So now it's a bit bigger than usual, but they have been building a pretty solid cash reserve for a very long while. So not necessarily a clear indication of what's going to happen. And between you and me, I'm nowhere near being Warren Buffett, and you are nowhere near being Buffett or either. So there's no point of trying to mimic what he does. It's I'm going to to mimic anybody that goes to the Olympic, and I'm gonna have like their same, like I'm gonna eat what they eat, and in 4 years I'm gonna make the Olympics, or probably not, right? So yeah, so that's for Buffett. Now going back to Japan. Japan is definitely stuck between a rock and a hard place. The thing is, they've been living with 0% interest rate for so many years that a lot of investors now started the yen carry trade. So yen carry trade, pretty easy to understand. Imagine that you can borrow yen at 0%. That sounds pretty cool, right? So you borrow the yen at 0% in Japan, and then you turn around and you switch the yen to, let's say, US dollars, and you buy the S&P 500. So buying the S&P 500 over the past 5 years generated a ton of returns, right? In the meantime, for the yen, you pay 0 interest rate. So it's kind of like getting paid almost to invest if you factor in inflation. So that thing works incredibly well until the yen collapse, or until the Bank of Japan decides to, surprise, increase interest rates. So this is what's happening. So that created commotion. Why? Not because of the amount of interest rate. It's like not a huge amount, but the thing is, a lot of those investors are hedge funds and they use leverage. And whenever you use leverage, it bolster your return, but it also create a much bigger hole when you are down. We saw that in 2020 with the COVID. We saw that also. The first time I think we really saw the impact of like leverage and hedge fund was in 2008, when a lot of people were high on margin, and then when the market goes down, the problem happens is you're getting called by your bank and you have to cover your margin. You can't, so you have to sell everything. We had a pretty good example with GameStop with the short squeeze, where as GameStop kept on going up, brokers and bankers were calling their hedge funds and say, you have to cover your position, my friend. And unfortunately, they did not have enough money, so they were forcing to sell their asset. So when hedge funds are selling massively their accounts, well, you can imagine that it has a domino effect on everything else on the market, and then it creates a little bit more of panic, and then in the end, everybody is selling. That's pretty much what happened on Monday. Then on Tuesday, everybody was like, it's all good. Nothing is wrong. We're going to keep doing whatever we have to do. And today, not today, but yesterday on Wednesday, the market doesn't really necessarily have a clear direction, but still, I'm reviewing a lot of earnings these days, and some sectors are doing crazy well, but a lot of like other sectors, especially when you're close to consumers, you really see the pain coming up. It's building right now as a lot of consumers feel that they're tight with their budget, they lost their job, or they have to pay a higher mortgage, and now, well, they cut on extra expenses. So leisures, going to Disney World, home renovation, apparel, going to the restaurant, no thank you. So all of those things are slowing down. So my take going forward for this fall, I don't know what's going to happen. And I don't pretend to be a guru and know exactly, you should do this because we're going to have like this major market crisis. I don't know. And you know what? I don't care because it's completely irrelevant. Because when I invest, I'm not thinking about what's going to happen in September. I'm actually a lot more busy to think about what I'm going to do for my birthday because it is in September. That's a lot more relevant to me than what's going to happen in the stock market, because you know what? In October, I will still be invested, and in November as well. And in November of 2034, you know what I'll be doing? I will be invested. So whatever happened this fall, I don't care. If we hit the recession, I don't care, because my portfolio was invested yesterday, is invested today, and will be invested for decades. I like to think in decades, even when I'll be retired. And I had that question on my YouTube channel, and I loved it. I think it was Rob asking me, like, well, imagine that in 20 years or 30 years, you're retired, you're like 60 or something, and then you have the chance to invest in GICs at 15%. And I'm like, I don't mind. I will keep my portfolio in equities, and while I will become older, maybe I'll be like 65, 70, 75, 85, I'll be thinking about the next generation, because my goal is not to deplete my entire portfolio. I'm going to keep a part of it for me, and the rest will be for the next generation. So again, thinking in decade, for me, not necessarily for everybody, but that's the way I see it, will make it happen. So while the noise will grow in the coming weeks, that's my take. I think there will be more noise, more story, and maybe we're gonna have some panic at one point. It's still always the same story. It's still the same movie. And I know it ends with another rebound after the crash. So instead of trying to time both the crash and the rebound, I'm just going to stay invested and be super happy about the companies I have. All right, Moose, that's enough for today. I hope that you have enjoyed it. Tomorrow it's going to be Business Friday, and I have like some interesting takeaways about my business tomorrow. So stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.